All right, let's dive in. Today we are tackling a topic that is absolutely crucial if you own or even just dream of owning property in Mexico. We're talking about capital gains tax. I know, tax isn't the most exciting word, but trust me, understanding this can save you a ton of money and a massive headache. We're going to break it all down. So just imagine for a second. You've decided it's time to sell that gorgeous little house you have on the beach. The sale goes through smoothly, the money's coming, and you're already thinking about that nice profit. But have you stopped to think about how much of that profit you actually get to keep? Well, here's the number that can be a real shocker. In Mexico, the capital gains tax can go as high as 35% of your net profit. Yep, 35%. It's a huge number, and it catches so many foreign sellers completely by surprise right at the closing table. So, to make sure that doesn't happen to you, here's our game plan. We're going to walk through this step by step. First, we'll talk about that surprise tax bill. Then, we'll get into how your profit is actually calculated. We'll explore a potential way out, the primary residence exemption. We'll cover the big mistakes to avoid, connect it all to your U.S. taxes, and finally, we'll build you a rock-solid action plan. Okay, first up, the surprise tax bill. Let's get a handle on what this tax even is, and more importantly, who's in charge of it. Because I guarantee you the process is different from what you're probably used to back home. At its heart, the idea is pretty simple, right? Just like in the States, Mexico's capital gains tax is just a tax on the profit you make when you sell something valuable. In this case, your property. The big difference is that this is all figured out and handled right there in Mexico at the very moment you close the sale. And the person who handles all of it is called the notario. Now, this is super important. A notario is not just a notary public who stamps documents. Think of them as a high-level, government-appointed lawyer who has to make sure the entire transaction is legal. They are the one who calculates your profit, figures out the tax, and literally withholds that money from you at closing. So how in the world does the notario actually figure out what you owe? Well, it all boils down to a pretty simple formula, but the little details inside that formula, that's where things can get tricky. Everything starts with a term you have to know, cost basis. You can think of your cost basis as what the Mexican government officially sees as your starting investment. It's built on the purchase price that's recorded on your deed, plus a few other things we'll get to in a sec. And this, right here, is the single biggest trap. For years, it was kind of common for buyers to be advised to declare a lower purchase price on their deed. Why? To save a little bit on the acquisition taxes when they bought. The problem is, when you go to sell, the tax authorities only care about that lower official number on the deed, not what you really paid. This creates a giant phantom profit on paper. The math is really straightforward. The notario takes what you sold the property for, and they subtract your official cost basis. Whatever is left over, that's your taxable profit. So you can see, right? A lower cost basis automatically means a higher and often much higher taxable profit. Now, there is some good news. You can increase your cost basis, which is great, because that lowers your taxable profit. You can add things like the real estate commissions you paid, and most importantly, the cost of any big improvements you made, like adding a pool or renovating the kitchen. But there's a huge catch. And here it is. For any of those deductions to count, your commissions, that new kitchen, anything, you absolutely positively must have an official Mexican tax receipt for it. This is called a factura. No factura, no deduction. A regular receipt from the hardware store won't cut it. It's that black and white. Okay, so you might be wondering, is there any way to pay zero tax? Well, there is one major potential loophole, the primary residency exemption. It's an amazing tool if you can get it, but as you're about to see, the bar to qualify is set really, really high, especially for foreigners. See, to claim this exemption, it's not enough to just say, oh yeah, that was my main home. No way. You have to prove with official documents that you are a formal tax resident of Mexico. We're talking a temporary or permanent residency card, plus utility bills like your electricity and phone bills, and they all have to be in your name at that specific address. For most foreign owners who aren't living in Mexico full-time, this is pretty much impossible to achieve. Okay, so now that we've got the basics down, let's really shine a spotlight on the most common and the most expensive mistakes people make. Knowing what these traps are is the best way to make sure you don't fall into them. We've touched on this, but it is so important it's worth saying again. That old advice to underdeclare your purchase price, it's a disaster waiting to happen. You might have saved a few bucks on taxes way back when you bought the place, but now you're facing a massive tax bill because of that decision. That small saving back then creates a huge fake profit now. And believe me, you will pay for it when you sell. And here's another very specific trap. This one for anyone who bought pre-construction. You'd think your cost basis would be set when you start making payments, right? Wrong. Your official cost basis is set on the value recorded when the deed is finally delivered and registered, which could be years later. If the developer underreports that final value to save a little money, guess what? Your cost basis is now artificially low, creating that same phantom profit problem for you later on. So let's say you've closed the sale and settled up in Mexico. You're all done, right? Not so fast. For U.S. citizens, paying your tax in Mexico is only part one. You've still got to get everything squared away across the border. Now, the fantastic news is that the U.S. and Mexico have a tax treaty designed for this exact situation. It's there to prevent double taxation. Let me say that again. You will not pay tax twice on the same profit. However, and this is a big however, you are still absolutely required to report the sale on your U.S. tax return. What happens then is your accountant applies for a foreign tax credit for what you paid in Mexico, and that almost always cancels out whatever you might have owed in the U.S. Okay, we've gone through the rules, the math, the scary pitfalls. Let's pull all of this together. Let's build a simple, proactive checklist that you can use to protect your investment and your profit. Here's your action plan. It's 4 simple steps. Number 1, from the day you buy, you have to insist that the true full purchase price is recorded on that deed, no exceptions. 2, for every single significant improvement you make, you get and you save that official factura. 3, work with a top-notch professional team. A reputable notario and a good lawyer are worth their weight in gold. And finally, number 4, talk to your accountants, both your Mexican one and your US one, way before you even think about listing the property for sale. And that really brings us to the end. If there's one thing you take away from this, let it be this: preparation is everything. The choices you make on the day you buy your property will directly impact your wallet on the day you sell it. So the real question I'll leave you with is this: is your paperwork right now setting you up for a truly profitable sale?